the July 19, 2023 Board of Retirement meeting. If we could do the trustee roll call, please.
Trustee Cubison?
Here.
Trustee Cavanis? Here. Trustee Jurdy?
Here.
Trustee Cromer?
Here.
Trustee Shoemaker?
Here.
Trustee Harris? And Trustee Anderson?
Here.
Thank you. We'll do the Pledge of Allegiance. If everyone will stand, please. Ready? Begin. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. That takes us to item number 1, which is the proclamation honoring Kathryn Smith for her service as a MCERA trustee. I see she's online. Welcome, Kathryn.
Good morning, everybody.
There. So I'll read the proclamation honoring Kathryn Smith for her service to the Mendocino County Employee Retirement Association and the Board of Retirement. Whereas Kathryn Smith has served as a well-respected Board of Retirement trustee, board chair and vice chair, and ad hoc committee appointee since being appointed by the Mendocino County Board of Supervisors in July of 2017. Whereas Kathryn's valuable knowledge and experience in business administration, finance and investments, budget management, policy development and implementation, and an honest dedication to the County of Mendocino has been a valued asset to the board. Whereas Kathryn approached her position as a trustee with the utmost professionalism by exhibiting a positive attitude and exceptional attention to detail in her fiduciary responsibilities, her humor and cheerful disposition were always welcome and genuinely appreciated by colleagues and MCERA staff. Whereas Kathryn navigated numerous difficult matters as a trustee and was always guided by her ethics and integrity when making decisions regarding investments, consultants, and policies, aiding in addressing the Mendocino County Employees Retirement Association long-term sustainability and exploring options to pay down the unfunded actuarial accrued liability while being the best possible fiduciary. Whereas Kathryn's valued contributions to MCERA include development of the 5-year strategic plan, implementation and monthly review of the Historical Benefit Review Project, receipt of an agreeable Internal Revenue Service compliance statement, and procuring new investment in infrastructure. Now, therefore, be it resolved that the Mendocino County Board of Retirement honors Kathryn for her years of service and expresses its most sincere appreciation. Kathryn is wished a happy and fulfilled retirement and all the best that life has to offer. Thank you, Kathryn.
Thank you. I just want to add, I have learned so much from my time on the board. You guys all have added to my knowledge and background of investments and business practices, and I just appreciate every single one of you. And I thank you very much for letting me spend the last 6 years with you. It's really been good. So thank you very much.
Thank you, Kathryn. Trustee Jurdy.
Yeah, Kathy, I just want to thank you personally for dedicating 6 years to this board. This board isn't necessarily one that members of the public want to go on to because it's such a challenging task for the board to provide a sustainable pension plan. But it is one of the most valuable boards that a member of this community can serve on, and I really appreciate the fact that you were willing to serve for 6 years and put so much effort into your service.
You're welcome. Thank you.
Thank you. Trustee Harris.
We're all going to really miss you, Kathy. It's certainly been my pleasure to get to know you in a different venue other than college and College Foundation. And I know I speak for everybody to say meetings aren't going to be quite as much fun without you here.
Well, thank you, Jerry. We'll still do our lunches, though.
And thank you. Is there any public comment on item number 1?
I'd like to toss something.
Vice Chair Shoemaker.
Kathy, thanks so much for being working as our chair and being drafted for that second round of being the chair. Working through the evaluation process, but to also broaden the thank you is you're a person that's, I believe, contributed a massive amount to the county of Mendocino, not just here through this board, but through your work at the college as well. And very glad you were part of this community. Thank you.
Thank you, Richard. I very much appreciate it. I appreciate all of you. Thank you so much. Good luck.
Thank you, Kathy. I'm not seeing any public comment. We'll move on to an item I skipped, which would be public comment on items not on the agenda. Members of the public are welcome to address the board on subjects both on and off the agenda. Is there any public comment at this time?
There's no public comment, but our new staff member, Alicia Williams, is online. I just wanted to bring her in just for a moment to say hello. I'm trying to get her connected. There she is.
Hello, everyone. I'm Alicia. It's going to be a pleasure working with you all.
Thank you and welcome.
We realize since we're not having these board meetings in our own chambers that we lack that connection with the MCERA staff. So we just thought we'd bring her in real quick this morning. Thanks, Alicia.
All right. Thank you.
Trustee Harris, go ahead.
If I might, to the board and everybody else who is here today, introduce a longtime friend and outstanding community member, has been in this county probably, well, as long as I have, so I know it's over 40 years. Charlie Kelly in the audience, who has applied for a position on the board as a public member, and should the board choose him, I know that it would definitely enrich all of us. Plus, he's a Rotarian, he has broad community support, and I appreciate the fact that he was willing to apply.
Thank you, Trustee Harris, and welcome. Thank you for attending our meeting, Mr. Kelly. Seeing no other public comment on items not on the agenda, that'll take us to item number 2. All matters on the consent agenda are approved by unanimous consent unless a board member would like to pull an item for separate motion or action. Not seeing any such motion, those items on the consent agenda are approved by unanimous consent. Takes us to item number 3, discussion and possible action regarding investment matters. It looks like we have numerous members of T. Rowe Price online.
Sure. Morning, board. We've got some members of the T-Row team here today. Eric Cheskin, a relationship manager, Lowell Ura, head of multi-asset solutions North America, and Jason White, a portfolio specialist. And they're going to provide a little bit of education and a performance update for you. So I'll send it over to Eric and he can take it away.
Thank you, Robert, and thank you, board, for having us. We've appreciated the relationship with you all over the years. I know some of you are new to the committee, and I wanted to make sure that we provide an educational update for you all. Robert did a great job introducing, so I don't have much to add. We're going to start off with an update from Lowell Ura that will cover broad market and what we're seeing in the public space with plans such as yours. Before we get into that, is there any comments or questions from the board that they'd like us to specifically address? All right, hearing nothing, I'm going to hand it over to Lowell.
Great, thank you, Eric, and thank you all for having us speak today. Eric and invited me to talk about some of the things that we are seeing in public funds across the country. I had recently spoken at a public fund conference, and it was fairly well received, what I had to say, because we are at an inflection point in interest rates that we really haven't seen in many decades. And so what we did is we took a look at a little bit of history and how do we get to this place from regards to the economic environment and what impact that path has had on plan sponsors' asset allocation and what may it mean going forward. So view this really as an as kind of a overview of the landscape of what's gone on in the environment and how your peers and the broad public fund universe have responded to that. And the other thing I will talk about, time permitting, is just our outlook on markets and kind of how we're positioning. And I'm sure you're going to hear some of that from Jason as well. It's, you know, related to the portfolio. So I think for my presentation, I want to focus on kind of the environment and how it relates to public funds. And I'll probably talk for 20 minutes or so and leave plenty of time for questions. But if there's questions as I go through this, please don't hesitate to stop and ask for clarification. I will start by saying I have been doing presentations like this for probably 25, 30 years. And this is by far the most interesting time for people in this industry in the last 30 years. And the reason for that is we've seen sudden changes in the economic landscape before, but what we haven't seen before is a very sharp increase in interest rates. And we haven't seen a sharp increase in interest rates from a starting point of zero interest rates or zero cash rates. And so if you go back to previous periods where we've had sharp moves up in inflation of the magnitude of what we've seen today, they've come from a place of starting at 3, 4, 5% interest rates. They've never started at a place of 0% interest rates. Of course, we got there from the global financial crisis. And what this means from the public plan sponsor universe is, wow, this is a different environment. For years, public plans since the global financial crisis have been looking at lower and lower and lower interest rates. That's done two things for public plans. One is it's had them rethink their actuarial return on asset assumption, which of course is used to discount liabilities. And two is it's had an impact from an asset allocation standpoint. Where do we put our asset allocation, or how do we position our portfolio to hit these higher returns that we need to generate to keep up with the increase in funding, decrease in funding status that comes with lower interest rates. And so I hope that you find this educational. It will provide some context for future discussions that you have amongst yourselves and with your consultants. And so hopefully that gives you a little bit of color on what we're talking about. So I'm not sure if who's advancing the slides, but I'm going to start on page 2, which just shares some key themes that we've been hearing from our clients. Thank you for that. So on the very next page are some examples of things that we've been hearing from our clients. And is that page visible for everyone?
Yes, we have the presentation up.
Great. So on this page is just a sampling of things that we've been hearing from our clients. And we often use this page to spur conversations. But in this case, I'm going to focus on what's in the top left, the forward return expectations and what that means for asset allocation. Your plan, looking at your asset allocation, really hasn't had many of the other challenges that are on this page, particularly things like liquidity and denominator, because you've been slower to move into many of the private asset classes that we've seen more broadly. And so those topics of interest are really less relevant to your plan because of the way you allocate it. And actually, it puts you in a very good position going forward. So on the next page is where you see two lines, and the line in green represents the median public fund return on asset assumption. And it ends at a point which is basically exactly where you're at, 6.75%. And then the blue line is 30-year returns of public pension plans. And so it's been a relatively good environment for many plans over the last 30 years, because while the lower return on assumption asset has resulted in higher liabilities, assets have been keeping up and have been above those lower return assumptions. And so we have seen in many cases the negative effect of lower discount rates on funded status offset by the higher returns. And you've seen that as well in your funded status that I believe is in the mid 70s over that time period. But I think it's important from a historical perspective to look at what drove these return on asset assumptions lower and what really drove these asset prices to do very, very well. And on the next page, what you see is a chart that shows the 10-year treasury bond or as a good proxy for where interest rates, and this is on page 4 of the presentation, so the page following what's up on the screen. It shows what the treasury bond was over time, and you'll notice that since the 1980s, when Volcker took the stand that the Fed was going to fight inflation and raise interest rates, we have been in the secular decline of yields for many, many decades. And you could really mark 2022 as the end of that era. And this really did two things. One is when you have lower declining yields, you have lower cash rates, of course. And when actuaries, asset managers, consultants develop return assumptions for asset classes, they use a building block approach that starts with the risk-free asset. And the risk-free asset is cash. In some cases, it may be the 10-year treasury bond. But either way, as these declines happen, the starting point for building an assumption on equities, high yield bonds, investment grade bonds, all starts with what do I get for the risk-free asset, which is cash, and that was 0. And on top of that, I put a premium for taking risk. And in the case of equities, that premium typically is around 4% over cash over the long term. And so those return assumptions, as you're probably aware of in your work with your consultant, have been coming down and down and down over the last 15 years, particularly since 2007 or 8 with the global financial crisis, where interest rates dropped to basically 0. And so that really, really was the primary driver of two things. One is plans lowering that discount rate slowly over the past 15 years since the GFC. And it took about 15 years to actually lower return assumptions from about 8% to about 7%, 6.75% is again where the industry is, exactly where you're at. And I think that's the right approach going forward, is to be very incremental, because we're in uncharted waters and you don't want to have a knee-jerk reaction given how large the shift in interest rates we've seen going forward. And so on the next page, what we see here is explicitly how did that impact asset prices. And so on the left-hand side, you can see the returns for stocks, bonds, and a 60-40 portfolio as a good proxy for a public fund portfolio. And you can see in blue is the equity returns, green is the fixed income returns, and purple is the 60-40 portfolio. Since that period of high interest rates, both stocks and bonds did really, really well. And you can see on the right-hand side, we broke those out into decades, and decade by decade, stocks and bonds generally did very well, with really two exceptions. One was the 2000s, where stocks were negatively impacted from 2000 and 2003 with the bursting of the tech bubble. And the current decade, which is heavily skewed because we've only have 2 years of data, 2 calendar years of data here, heavily skewed by last year's sell-off in fixed income when stock bond correlations went to 1 as the market struggled with determining how inflation was going to impact the broad market. So with the exception of short periods of asset classes not working, the lowering of interest rates translated into better bond returns, because declining rates is better for bond returns. And the lower interest rates and the Fed policy, particularly post-global financial crisis, has been very supportive of risk assets. More liquidity in the system, more returns out of risk assets. So it's been a really, really, really great environment. for both stocks and bonds over the last several decades. And you saw that in the previous graph, where despite the starting point for yields being lower and lower year by year, assets continued to do well. So the question is, from our standpoint, how have plan sponsors responded? And on the next page, you can see the broad universe of public plans. And this chart shows how asset allocation has shifted over the last 20 plus years, since 2001. And so the dark blue on this graph is public equities. The light blue is fixed income. And if you look all the way up, and the other colors are various flavors of alternatives. The dark green is private equity. The lighter green is real estate. The darker purple is hedge funds, and then the lighter purple is all. So basically everything other than blue is alternatives. A little bit of cash is in there, but basically I wanted you to focus on the traditional liquid stocks and bonds over the last 20 years or so. And you can see that traditional stocks and bonds started out in 2001 comprising 90% of public fund assets. And by today, it comprises really less than about 70% of assets. And the reason for that, and the reason why many public funds push into these riskier assets and took on this illiquidity risk in private equity and other private assets, is to offset the lower return assumptions for the liquid assets. And so we've seen a significant change in allocations in response to an environment that many felt it would be more challenging to reach their EROA target. And you can see this more clearly if you start to break out these lines on page 7, for example. We show how significant the growth in private market investing has been over the last 20 years or so. So on this chart, you can see we started 20 years ago at about 10% allocated to private assets. And in that case, it was mostly private real estate and a bit of private equity. And by the end of 2022, what you can see is that the average or the median public pension plan was all the way up at 35% allocated to alternatives. And your plan is about, I believe, 17% allocated to alternatives between infrastructure and real estate. And so it's kind of an outlier. And I'm sure that's something you're aware of. And you've been able to hit that EROA target without taking on that illiquidity risk. And so you're in a somewhat different situation than many of your peers, facing an environment that is going to be very different going forward. And quite frankly, that really puts you in a good position for reasons that I will get into. So the other thing that I think is interesting is on the next page, where you get a sense as to where this came from. Where did this funding for alternatives come from? And it came predominantly public fixed income. You can see the big drop in fixed income. And so again, going from a safe haven, lower return asset class in fixed income into a higher return group of assets in private market strategies and hedge funds was one way that plans were going to be able to model through their annual asset allocation study, one way for them to model an asset allocation that would achieve this return on asset assumption, return on asset bogey, without having to lower it too quickly, which of course would have negative consequences if you had to be forced to lower that assumption too quickly, because it would drive up the liabilities and decrease your funded status. So that was the major change that we've seen, is a shift to private assets and a decrease in public equity, public fixed income. On the flip side, when we look at the equity situation on the right-hand side, on the next page, here you can see the total equity allocation broken out between public and private equity. And you can see just a modest drop off in the allocation to equities in total. But it really, and I'll get to this in a second, the amount of exposure to equities really didn't decline. It actually increased, because what happens when you allocate from public equities to private equity is there's leverage in private equities. For every unit of private equity that an investor owns, because of the characteristics of the underlying asset class, there is either explicit or implicit leverage in the strategy. And the implicit leverage comes from the fact that they are tending to allocate and buy smaller companies that have more volatility. And so when we look at the true exposure to equities of plans and how that's evolved over the last 20 years on the next page, you can see that despite the exposures showing that they've declined, as we show on the previous page, the exposures to equity has actually increased. And so the blue line is the same line from the previous page. The green line is a estimate of how much equity exposure the typical plan has. And what we did is, it's in the footnotes on this slide, but we said private equity has 20% more equity exposure than public equity. So we multiplied the exposure to equity of about 1.2%. And other things like real estate have equity characteristics, not purely, but less, and much less so than private equity. So for example, the average real estate strategy has a 40% relationship with the equity markets, because real estate does do better during the business cycle, and it does have a relationship with equities. Same thing for hedge funds. Hedge funds are not purely market neutral and have no exposure to hedge funds. Hedge funds have, in general, some positive exposure to the equity market. So after we make those adjustments and actually extract what we call this hidden beta in these other asset classes, the actual equity exposure of your typical plan has actually increased, even though on the line items that you see in a report, it looks like it decreased. And so that's another thing to point out, is that when you look at kind of the notional exposures to asset classes labeled as equities, it may look like they've declined, but when we look at most plans, it's actually increased. And the same thing has happened actually for other risky directional factors in portfolios, such as credit. And we show on the next page an example of a study that we did for a public pension plan that really asked us to take a look at their allocation and their implementation of their allocation, and what exposures they have that they may not be aware of. And so what this table shows you at the very top of this chart, you see a shaded row that shows the total portfolio's exposure to global equity, the total portfolio's exposure to risk-free duration, and I would think about that as your exposure to core bonds, and then credit duration. How much exposure does a various plan have to the risky part of the fixed income markets, credit? So for example, if you think about high yield bonds, the risk-free component of a high yield bond is maybe 3 or 4%. The credit exposure is typically 3 or 4%, whereas investment grade bonds, the risk-free exposure is also 3 or 4%, but the current exposure, which is much riskier, is about 1%. And so this gives us a way to say, how much directional risk do you have, whether that's coming from equities or credit, versus how much safety do you have in coming from treasuries, risk or risk-free duration. So in this case, the total plan had 0.67 or 67% exposure to equities in their portfolio, and their benchmark was 60% exposure. So they structurally had 7% more exposure to equities than their benchmark. And you'll see on the right-hand side, credit duration was meaningfully higher. And again, credit duration being more directional, somewhat like equities, they had a lot more credit duration. And so what this told the plan sponsor is, despite the way I look at my asset allocation, if there's a risk on market, I should be expected to outperform quite significantly, because both my 7% overweight to equity exposure and my 28% overweight exposure to credit should do just do a lot better. And in a risk-off environment, we should expect to do a lot worse. And the plan sponsor then use that information to share information more broadly so that there were no surprises. Sometimes we do this type of work and consultants as well, and this may be too much of a mismatch, but it's always good, we find, to kind of look below the line items on the asset allocation report and say, well, what is the plan really exposed to? And you can see, we call it hidden market exposure because it's coming from places that you may not expect. So the traditional asset classes like large cap, small cap, non-US equities, EM equities, fixed income, most of that makes a lot of sense. You would expect their exposures to be basically what they were. But what you look at below that, and this client had a lot of hedge funds, they were getting a lot of equity and credit exposure from some of their hedge funds. And that was really overall driving up that equity and credit exposure. And so that's, again, something that we're very conscious when we think about our portfolio construction is it's really interesting to look at not only the asset allocation, but the specific managers that have been implemented in those asset classes because of the nuances and the idiosyncratic nature of managers. Some managers have more exposures to certain factors that may be unexpected to level set on where the exposures are. So I use this really as an example of kind of going back to my previous comments of the low interest rate environment made it more difficult for plan sponsors to achieve their return on asset assumption because the assumptions used in modeling came down and there was no alternative really other than to take more risk. And that risk came in the form of more equity risk, more illiquidity risk, whether it's private market strategies in equities, real estate, credit increasingly, and it resulted in a decrease in fixed income. So the real question is, where do we go from here? What's next? Well, I mentioned earlier that cash rates are really kind of the thing to look at to get a sense as to where market assumptions and modeling assumptions for your EROA are going to come from. And because we are in this unusual environment where the Fed is fighting inflation, but cautious to do too much because they don't want to hurt the economy, this is a very unusual environment because typically Fed funds and short-term interest rates are rising because inflation is coming from growth. That's the more typical approach. And so this shows you, again, going back to the 90s, that when we used to do asset allocation studies, we started with a cash rate of around 4%. But for the last 15 years, we started at an assumption of 1%. And again, that was the primary driver of taking more risk. And now we've just shot right back up to, and if I updated this through today, we'd be at above 5%. And the expectation is that we get to maybe a little bit higher. We top out at about 5.5%. The question is, where do we go from there? Where does cash rates normalize? And if you look at the markets, I was just looking before we jumped on this call, if you look at the markets as we get through the next 12 to 24 months, the market's basically saying that cash returns are going to settle out around 3%. But it's something that's quite volatile and something that we want to kind of keep an eye on. So I'll close with, I'm going to skip ahead a couple charts to page 15, because I think this is really the crux of the discussion. And that is on page 15, where we have this, what we call the playbook. I think it's, yep, right there. This is a construct that we use to think about asset allocation. It doesn't tell you what play to call. It just lays out the options. And when you have higher yield, you have inflation risk, you have these changing correlations that we saw last year in stocks and bonds, it means that we want to revisit how we generate return in our portfolio. And so this says to us, well, if we're going to get higher returns out of equities over the long term because we're starting with higher cash rates, then maybe we don't have to rely so much on equities to generate those returns. And again, you're in a little bit different situation because you haven't taken those assets and put them into private markets and locked up, and so you have more flexibility. But again, most plans have been relying almost 100% on equities and private markets to generate returns. This just says, well, we can probably think a little bit differently and more broadly about generating returns. And we want to think about liquidity risk in this environment as well, because of course, it's much more difficult to reallocate illiquid investments. And then on the risk mitigation side, we have a lot of clients telling us, well, gee, should we do something different because stocks and bonds had a high correlation last year? And the answer is it depends. We do believe that there is no better diversifier in a portfolio to a risk-off environment than having a healthy allocation to core bonds like you do. But on the margin, in the extent that you have environments where stock bond correlations have increased and you want to protect against those environments, we've seen many plan sponsors diversify their risk off ballast in their portfolio, their core bonds, into other types of strategies. And again, the purpose of this wasn't really to go into any specific approach that made sense. It was really just to lay out that the options and the considerations that many of the public funds are considering. So with that, I'm going to pause and see, do a time check, see how we're doing. I'm happy to answer any questions on this high level overview of what we're seeing. And I'm also happy to kind of share kind of our current outlook, time dependent.
Trustee Judy.
Yeah, so I think your presentation is pretty interesting. I think it was in the last meeting before last, I pointed out that I had read that the correlation between real estate and utilities was roughly 40% with U.S. equities. And you just said the same thing that I just said 2 meetings ago about the real estate. I don't know if you agree on the utilities asset allocation having a roughly 40% correlation with the equities market as well. But it's been pretty clear that this board has been moving in the last 10 or so years some money out of domestic fixed income into infrastructure, well, more recently into infrastructure, prior to that into real estate. And in talking with the trustee in Sonoma County, and I'm not saying they're on the leading edge at all, but neither are we. But they've moved their target to 26% into into infrastructure, and their primary 3 areas are more general infrastructure, utilities, which could be water, could be electricity, or real estate, and then finally, more recently, into farmland for agricultural products. And that's the area that they're now entering into with infrastructure in a pretty big way. So they have, I think, 3 different infrastructure advisors. I think we have 2. And so I personally think that that's a smarter way to go than I think we have too much allocation to fixed income myself. And, when I look at the last 10, 15 years looking backwards, the fact that we only earned about 2.5%, 2.25% on our fixed income, and looking forward, they're saying, well, maybe we'll earn 4% going forward. I'm not seeing any guarantees that we're going to earn 4% going forward. I think that's pretty optimistic myself. And I think it would be smarter for us to be looking at shifting more of our fixed income into infrastructure and looking at the different categories of infrastructure, maybe not putting it all in one type of infrastructure, like Sonoma County picking essentially three broad buckets. And so just kind of curious, maybe you're going to get to that point, but I'm kind of curious what your thoughts are on that.
Yeah, thank you. It's a really good question. When we think about asset allocation, and you alluded to this, there's really 2 primary factors that drive asset classes. One is equity markets, and nothing manifests economic growth in returns. And there's no replacement for core equities, public equities, really to kind of be the primary source of growth for any investor. Higher economic growth, all things being equal, will lead to higher earnings for companies in the broad market, and that there's no substitute for that in asset allocation. On the flip side, the other primary factor is interest rates. And you can really take just about any asset class, whether it be equities, subsectors of equities, like you mentioned, utilities, real estate, any risky fixed income. And you can say, well, a portion of that is going to be driven by economic growth, and a portion of that's going to be driven by interest rates. And infrastructure and real estate are perfect examples of things that have a allocation of both of those drivers, right? Because real estate does really well, of course, when interest rates are low. Infrastructure does really, really well when interest rates are really, really low. Different issues in different parts of the infrastructure market, of course, are less economically sensitive than others. And so when financing is cheap for real estate projects, for infrastructure projects, that should be good. And so what I'm getting at here is that is an approach that is a reasonable approach to diversification. Now, the question is when you do the asset allocation and you say, well, how much am I going to allocate to infrastructure? And you alluded to this, these explicit types of infrastructure or the explicit types of real estate investments, whether it's farmland or office properties, like two wildly different exposures, right? Office properties, they both have idiosyncratic risk. Like obviously COVID impacts office properties, and we're all aware of that today. But the business cycle is going to have a negative effect on different parts of real estate, office properties versus residential. And so this is where I get into my comments about implementation matters. And so as you think as a board about allocating more towards infrastructure, my suggestions are that you also understand what exposures are you leaving behind and what exposures are you getting, and are they what you want? So for example, looking at your portfolio, you have a pretty traditional core bond portfolio that's really going to, more often than not, with the exception of 2022, is going to protect you in a risk-off environment. Now, depending on what types of real estate infrastructure you invest in, you have to ask yourself, when we implement those allocations, is this a safer part of those markets that's less tied to the economic cycle? Because I've got my exposure to the economic cycle through equities. I have my risk off balanced in my portfolio in fixed income. And as I allocate and push out into infrastructure or other alternatives, we always caution investors to think about, are they getting what they expect? And so if you are comfortable taking more directional risk and investing in infrastructure projects that are more geared towards economic growth, and decreasing your ballast for risk off environments, that's completely fine. It's just knowing what you're getting. The other kind of thought is, well, if I really feel like I have the right amount of safety assets and fixed income, but I want to diversify and increase the breadth of my portfolio to generate returns, then maybe it's more interest rate sensitive types of infrastructure in real estate and less economically sensitive infrastructure in real estate. So again, coming back to the sense to, what do I have that's going to drive returns, and what do I have that's going to moderate that volatility? If you're first figuring out how much of that exposure you need, and then second is, where do I go and get it, if that makes sense.
Any other questions or comments from trustees before we move on? Go ahead.
So I would point out that we're about 30 minutes in. We scheduled about an hour.
Okay. Thank you for the update, Robert, and thank you, Lowell, for your time. If there's no further questions, I'm going to switch over to Jason White, who's the portfolio specialist that covers the international small cap equity investment that you guys have with us. So Jason, take it away.
Great, thanks. Robert asked us to do a quick overview of the team philosophy and process, and then talk about the portfolio and recent performance. So if you have the materials in front of you, page 16 would be a good starting point. So a couple of comments to kick off here. I think T. Rowe Price takes small capping investing quite seriously. This strategy was launched in 1988. It's been well resourced over that time. We have a multi-portfolio manager structure, which you can see on the left part of the slide. So we have 3 portfolio managers located in the markets in which they invest. Ben Griffiths, who's based in London, is the lead portfolio manager, and he is joined by 2 co-portfolio managers, Hiroshi Watanabe, who's based in Tokyo, who looks after the Japanese part of the portfolio, and then Wenli Zheng, who is based in Hong Kong, who covers Greater China for us. So we're big believers in having proximity to the markets in which we invest. So we have the portfolio managers in the markets that they're making investment decisions on. In addition to these 3 portfolio managers, we also have 7 dedicated small cap analysts. They are generalist by nature. Again, they are located in the markets in which they invest. So Da Wei Feng, for example, is based in Hong Kong, covering Greater China, sits next to Wenli. So there's a very short, in that case, about a 3-foot walk between where Da Wei sits and where Wenli sits. So having very close connections between the analyst and the PM, we think the PMs are very important. These analysts are generalists by nature. They're entrepreneurial, they're diggers. That's the nature of the asset class. This is an asset class where coverage is not great. A lot of the companies that we meet with, you can't go to Bloomberg, you can't go to the sell side and pull down a research report. So we have to do a lot of that heavy lifting ourselves, which is why we have this structure of 3 PMs plus 7 analysts that are dedicated to the international small cap effort. It's a cohesive team. We get together every other Monday for a call, about an hour and a half or so, talking about what we're seeing in the markets. Analysts are presenting new ideas. We'll have sector experts come in from our broader team, and someone like John Kiang, for example, on our metal and mining team will come in and give us their top-down perspective in terms of where they're seeing the metal and mining space and the material space evolve over the next couple of years. And then we use that information to go out and find small cap companies that can play on some of those themes, but also fit with our investment framework, which is broadly quality, durable growth companies that we think can be much bigger on a 3 to 5 year view. If you turn to the next page 17, this is the broader equity research team. I think this is one of the advantages that we bring to the table is on page 16, you have the dedicated resource for international small cap investing, which is great. But we get a lot of leverage from other resources at T. Rowe, whether that's equity research analysts like you see on page 17, or in some cases our fixed income analysts as well, getting their views on currencies, for example, or the direction of travel for interest rates or fiscal balances in some of the countries that we invest in. We do source ideas from the broader platform. You'll see a number of analysts on page 17 that are highlighted in orange. Those are analysts where we own at least one of their ideas in this portfolio. So really harnessing the best of both worlds in terms of a dedicated small cap team, plus the broader resources of T. Rowe. Page 19 gives you a sense for what we're trying to do. And it all stems from the nature of the asset class. I've been working on the team now for over 16 years. Over that time period, our opportunity set has more than doubled. A lot of that growth coming from Asia. So there's more and more stocks to look at. At the same time, resources that have gone into international small cap have largely been curtailed post the financial crisis, right? So Wall Street banks aren't putting as many resources, or in many cases, taking resources away from their research efforts in international small cap. And what this means for you as a client is this is an asset class that's not well known, that's undercovered, and under-owned by a lot of investors. Based on some rough math, we think about 1 in 3 professional investors have an allocation to international small cap. So if you put all of that together, what that means is this is an asset class that has very wide dispersions of returns. There's a lot of inefficiencies that can be exploited. And how we try to exploit that inefficiency is in a couple of different ways. One, we have to take a long-term view. So when we're researching a company and we buy a company, we're looking out at least over the next 3 to 5 years. In some cases, we've owned companies for over a decade. In a couple of rare cases, we've owned companies for over 20 years in the portfolio, consecutively or continuously, I should say. What we're trying to do are find companies that can be much bigger in terms of their cap, in terms of the scale of their business, over a 3 to 5 year view. Identify them, buy them early, buy them in a contrarian way if we can, because the market doesn't understand the opportunity, or we have a differentiated point of view, and being patient investors and letting those returns compound for our clients. The way we do that is through traditional bottom-up fundamental research, right? It's analyst-led, going out, understanding the companies, meeting with management teams, which is really important at the small cap level, talking with clients, talking with suppliers, talking with competitors. This is a very hands-on process. Collectively, the team that you saw on page 16, our international small cap team, meets somewhere between 1,200 and 1,300 companies per year. So we're turning over a lot of stones to try and find companies that we think fit with this investment philosophy. It is a diversified portfolio. It's about 220 stocks, roughly. The range is 200 to 250. That's not for pure diversification purposes, because we find a lot of ideas. And it's really hard to understand exactly which of those are going to be the winners, right? So we take a risk-adjusted point of view on our position size. A big position for us might be 200 basis points or 2%. Smaller position might be 30 or 40 basis points. Or again, this is a stock that we think we want to own over the next couple of years and has scope to be much bigger. So that's what we're trying to do. Definitely a growthier offering, a growthier portfolio. But that is based on our experience over the past 40 years, almost 45 years, in terms of some of the best ways to win in this asset class. If you think of the process on page 21, this is a bit more of a summary. There's actually almost 8,000 stocks in our opportunity set. We look at as low as 500 million in market cap up to about 5 billion. So that's a pretty broad definition of small cap. We look at both developed and emerging markets. From there, it's us going out, finding ideas, using pattern recognition. The analysts are pitching those ideas to the relevant portfolio managers who are making the ultimate decisions. The portfolio managers are talking to each other on a day-to-day basis to understand, where does the marginal dollar go in terms of the best ideas. But it's really a collaborative environment with the portfolio managers ultimately having the decision-making authority. Sell discipline is really important. I talked about being long-term investors. Our turnover in this strategy is typically around 30 to 35%, which is about half of our peer universe. So being patient investors, trying to identify these companies early, hold them for long periods of time, historically has been a successful playbook in terms of approaching this asset class. If we turn to page 24, we can kind of get into a little bit more what the portfolio looks like. And we actually feel pretty good about the portfolio today. The last 12 to 18 months has been a fairly rocky ride for the portfolio in no uncertain terms. 2022 was extremely difficult to be a higher growth small cap investor. But I think the advantage, what's happened over that time is things have gotten a lot more rational for us. If we went back to kind of mid 2021, valuations looked pretty extended to us. And we did try and trim some of the more expensive stocks that were COVID beneficiaries. In hindsight, we didn't do enough. But when we look at today, we look at page 24, for example, at that EPS growth rate, we're more than double the benchmark, 14.7% versus 7%. But when we look at valuation metrics, yes, we're at a slight premium to the benchmark, but we think we're getting a lot more growth for not that much more in terms of what we have to pay for the portfolio. So we actually feel pretty good from where the portfolio sits today from a valuation perspective. And there's never a shortage of ideas that we can go after. 221 stocks, talking of an active share north of 95%. So it is an active portfolio and something that we are constantly finding ideas. Page 25 just looks at kind of how we're positioned here. I'll highlight a couple of things. One, we're underweight emerging markets, and Pacific ex-Japan is a big part of that. You look at our emerging markets exposure over time, it's about 20 to 25% of the portfolio. It's on the lower end of that today. And then more and more of that has been focused within Asia, to a lesser extent within Latin America. China has been an area of opportunity, domestic Chinese exposure. Again, on a 5 to 10 year view, we feel very good about that. Over the past 12 to 18 months, that has not been a good allocation decision for us. But again, that's a market that we see a lot of inefficiencies. A lot of the companies that we're invested in sort of fall under the radar of regulatory scrutiny that some of the mega cap or large cap Chinese stocks have experienced over the past couple of years. In terms of our overweights, we've largely been overweight Japan for the past 5+ years. Japan's had a really nice run here in the second quarter of this year, largely due to a weaker yen. We see a lot of opportunity within Japan. It's a very eclectic part of the portfolio. We've had resources in Japan going back to the early 80s. We never abandoned that market. And there's been a lot more interest in Japan over the past 6 to 12 months. But we're seeing a lot of positive developments in terms of improvement in corporate governance, in terms of Japan reopening starting in early November. The team collectively was there in November, myself included, meeting with a number of companies and kind of doing a review of the process. Americas is mostly Canada for us. That's another area we're seeing a lot more opportunity, particularly in the metal and mining space. Canada is a market that kind of falls through the cracks for a lot of investors. It's one where I think in the past people viewed it as largely a commodity play. That has changed. There's still a big part of that opportunity set that is a commodity play, but there are a lot of other really interesting companies that we've found. And then Europe, overweight. That overweight has come down over the past 12 to 18 months. Within Europe, we tend to be most overweight the UK. The UK is a very broad and deep market. Most of the companies that we invest in the UK are not particularly exposed to the UK as an end market. They tend to be more pan-European, or in many cases, global companies, or having more global footprint. If you turn to page 28, this just gives you a sense for sector diversification. Relative to the last time we spoke, quite a bit's changed in the portfolio. Some of that is a recognition of the environment that we're moving into. So there are sectors where we tend to be more structurally overweight and have been structurally overweight in the past. Consumer discretionary, healthcare, to a certain extent, information technology. If you were to look over the past 10 or 15 years, those are areas where we find a lot of ideas. Technology is actually an underweight for us, which has been the first time we've been underweight in a long period of time. But also, we've done a lot more work in some of the other areas, energy, for example, materials, and real estate, even though well, energy now is slightly overweight, but even in areas like real estate and materials where we've not found a lot of ideas historically that fit with that quality, durable growth framework, we are starting to find more ideas. And a lot of that comes on the back of the work that our global natural resources team has done, prompted by Russia, Ukraine, prompted by people worrying about supply chains. Basically, the commodity space has been underinvested for the past 10 or 15 years. We see a larger portion of CapEx going into that area. So there's a lot of different ways that we're looking into that. But I think what you'll find what you find with the portfolio today is it's more balanced than it's been in the past, i.e. our structural overweights to consumer discretionary, to healthcare, to technology, or more moderate relative to history. And then some of the areas where we've seen historically a much larger underweight, while they still might be underweight, they're less underweight. And that's a reflection of, I think, the paradigm shift of what's worked in the market in the past 10 or 15 years with generally good growth, low inflation, low or negative interest rates. That's unlikely to persist over the coming years. That growth may be lower, interest rates will be a bit higher, and then inflation, wherever it settles out, is probably not going to be 0 or even below 2%. So just trying to be more mindful of the environment and still sticking to our knitting in terms of finding quality, durable growth companies. And then
Jason, can I ask you a question on this point? So you just talked about inflation is unlikely to be as low as it was in the rearview mirror. And I've been arguing that point too. That's what I consistently hear from the people looking at the market, and yet our actuaries convinced this board to lower our assumed inflation environment for the next 15 years to what we experienced in the last 15 years, which was 2.5%. What I've heard is that people are not expecting it to be as low as it was. They're not saying it's going to be 5%, but it's going to be something higher than it was, and it's more likely to be a little more volatile than it was in the past. So how would you characterize your expectations for inflation in the next 15 years?
Yeah, I think we would tend to agree. It's probably not going to remain elevated like we've seen over the past 12 to 18 months, partly because of some distortions from COVID and the Russia-Ukraine crisis. And you have seen inflation in some parts of the market start to roll over. The US would be an example of that. In other parts of the market, like the UK, it's still stubbornly high, still 7%. So I think the expectation for us, and we're not top-down investors, we don't spend a lot of time forecasting this, but if our expectations are of an inflation rate of somewhere between 3 and 4%, maybe 5% on the high end, that is conducive to equity investment. Particularly for some of the companies that we invest in where they do have pricing power and they are able to put that on, or push those costs on to their customers. So yeah, we would think that even from elevated levels today, it will still come down. There are confounding factors, right? Labor markets are generally much tighter. Demographics play into that, and the offset is going to be productivity gains. There's a lot of talk about AI. That's still very early innings to understand how that may affect the trajectory of inflation. But I think most people on the team would agree that we're probably not going back to a sub 2% inflation regime.
So if you were to predict which is more likely, next 15 years, the average inflation, looking back 15 years from now, it was 2.5% or 2.75%. Which do you think would be more likely to be true?
This is pure speculation, and maybe Lowell can chime in because he may look at this a little bit more closely than us. I personally, I would think it would be 2.75%. Partly just because the energy transition is going to take a lot of money, a lot of capital. It's not going to be immediate, and there's a lot of work to be done there.
I would just add, I think this is one of the benefits of T. Rowe Price in that you have folks like Jason and the team looking at things from the bottom up and focusing on inflation as it relates to their time horizon. And folks like us who sit in the same shoes that many of you do and run multi-asset portfolios and have to think about these things over a much, much longer time horizon because our investors, like a public pension plan, are investors over a life cycle. And in your case, it's multiple life cycles because it's open and there's new clients. And so your actuary, your consultant, tend to have much longer time horizons than a bottom-up manager, like the strategy Jason is talking about. And so we tend to start by looking at ultra long-term break-even inflation rates that the market is basically telling us. And basically, the market's telling us that inflation is going to be about 2.25 over the next 10 to 15 years. We also think it's likely to be a nudge higher, but that's a really good starting point for an actuarial assumption for a public defined benefit plan is what is the market pricing in? The Fed's explicitly targeting a level of inflation around that. And it's probably, all else being equal, it's probably not a place to be an outlier too far from what the market's pricing in and what the average economists are pricing in, because you'd have to then justify it. And it makes it really, really challenging. And so this is where I think, you kind of have to make sure you're coming at this from the right horizon for the plan and going out and kind of where the market is pricing in inflation. And 2.25, whether it's a 1/4 point higher, 1/4 point lower, there's plenty of arguments for both sides, even 0.5% higher. But 2.25 to 2.5, definitely for the next 15, 20 years is what's being priced in today.
Well, they were pricing the 2.5 based on the fact that the Fed is publicly saying that they're retaining their target of 2% long-term inflation. And there's incredible debate about whether or not at some point the Fed will raise that after they say they can't achieve it. And that whether they say that, they never say that, or whether they say that 6 months from now, a year from now, we will see. I predict at sometime in the next 2 years, they're going to say they cannot achieve 2% long-term return. And then the market projections that you're talking about will go up because officially the Fed will have said 2% is not achievable.
Our financial investment officer has a comment.
So Lowell did sort of mention this, but I did want to point out to the board that as of yesterday, the St. Louis Fed thinks break-even rates, 10-year market rates, 2.23, and the 30-year is also at 2.23. So I would also point out that China is going through a deflationary recession right now, and we may very well be heading that way. Luckily, we do have an actuary in the audience that's going to talk to us shortly, so we can debate that then.
Thank you. Any further discussion or comments at this point? Trustee Harris.
Sorry, lost my ability to speak. Jason, I wanted to ask about, you have an office in Hong Kong. And I was fortunate to be able to be there in a global pension forum in another life. I was struck by the location on the South China Sea, the amazing harbor, buildings, the largest building in the world was there in the Hong Kong, there on the harbor. So in that office and in your experience, what has happened as the students of Hong Kong arose in riots, basically to try to keep freedom in that city as had been promised from mainland China? And the difference that you see, if any, between then and now as far as its crucial role as a hub of it worldwide investment?
It's a good question. So I've been going to Hong Kong for about 15 years. It feels different over time. I haven't been in the past couple of years since excuse me, since COVID. It was probably 2019 was the last time I was there. But every time I go, it feels directionally that it's moving more towards China. That the mainland is more prominent. Obviously, there's been a lot more unrest that we've seen. I guess it's sort of died down, or it's not as front of mind necessarily in terms of the media per se. But it definitely has changed. It feels more mainland. This is just my personal opinion, having traveled there for a long period of time. I think that a lot of our employees, it's a mix of folks that are from Hong Kong, or folks, and also folks that are from the mainland. And I think that they have very strong feelings around Hong Kong remaining more on the independent side, more of a traditional Hong Kong. But it seems like that may be at odds with the direction of travel from the central government.
Thank you.
It's still a great city to visit.
Trustee Jurdy.
So we're looking at the returns for the last 10 years. I realize it was founded May 31st, 2013. I don't know when we put money in it, but just looking at your long-term returns and comparing it to the small cap exclusive of U.S. index fund, and it's got a favorable net return over that. What I'm not seeing is what's the standard deviation or the volatility of the fund as it relates to other funds. So can you maybe, whether it's here or later, give us the standard deviation between this versus an index fund, so we could also compare it with our other portfolios? Because one of the things that I want us to look at is both the net return of our funds and the volatility, the standard deviation of those funds, and also the maximum drawdowns that they have. Because when we're looking at building a portfolio, it seems to me that we're not attempting to get the highest return. If that was the case, we'd put 100% of our money in the U.S. stock market, probably, or virtually all of it in the U.S. stock market. But what we're trying to do is have a balanced fund that modifies volatility. And so when I look at each of our funds, I'm wanting to know how are they performing both on net return and on standard deviation and maximum drawdowns.
Yeah, I don't have an updated standard deviation for you. We can follow up with that. But historically, if we look at long-term results of this strategy, 10, 15 years, we've been able to outperform with less volatility of the benchmark. And I know if you look at the last 10 to 15 years, this asset class typically has had far better returns with far less volatility than something like emerging markets, for example. So within the international space, historically, international small cap has been a good source of positive risk return, or the returns that you're able to generate in the asset class relative to its volatility has been positively skewed. But we'll follow up with more concrete numbers for you.
Mr. Ravelis.
So in answer to Trustee Jurdy's question, according to the most recent Callan report, the 5-year standard deviation for the strategy is somewhere around 26. Which is higher than some others, but again, considering the strategy being an international small cap growth strategy, that's expected.
And just for relative terms, for everybody who's not looking at this all the time, and I'm not looking at it all the time, but the combination of U.S. mutual funds that I was saying look like they have less standard deviation, less volatility than the S&P 500, which was a combination of our Now, you know, these are US domestic, but that was the Fidelity Low Price Stock Fund that we have, a third in the Vanguard Healthcare Fund, and a third in the Vanguard Dividend Growth Fund. That had, by comparison, a standard deviation over the last same time period, same 10 years, a standard deviation of 10.6. S&P 500 had a standard deviation of 14.5. So when we're hearing a standard deviation, I know this is different. This is international small cap, but when in same 10-year period, standard deviation of over 20%, you can see it's much more volatile. Even though it's a small part of our portfolio, it's much more volatile part of our portfolio than the bulk of our the largest portions of our portfolio.
The standard deviation for the same period from Fidelity is around 24. So while the capitalization within the strategy is quite different, the standard deviation is relatively similar, 24, 26, very different than 10 or 4 for a fixed income. So that's just something else to consider. These are broadly similar, you could say. They're 24% versus 26%. They're not the 30% of a small cap US, but they're similar.
Thank you. I think we're nearing our time that we allotted for these presentations. Is there any representative from T. Rowe Price that would like to provide an overview or any closing comments or remarks?
Yeah, I'll handle that. Thank you, Chair. I just wanted to thank the board for their time. We really appreciate these lively discussions and your interaction, and it's great. So we look forward to joining you again, hopefully in the coming months and years. We thank you for the partnership long term, and we look forward to talking again soon.
Thank you all, and take care.
Thank you.
We have one other item under 3, which would be the monthly MCERA investment performance report from Callan, for our financial investment officer. Are there any other remarks on that item that you would like to
No, you know, the one thing I would point out is the preliminary fiscal year-to-date number, 8.73%. Of course, that doesn't include the quarterly returns from real estate, which I'm unfortunate to report are going to be negative for the period. And that also doesn't include the update from JP Morgan, which I do expect to be positive, probably in line with IFM. On the longer term scale, we can see the return of 7.67%, which is higher than our expected return even a decade ago, so which would have been 7.25. So that's good news.
Thank you. Are there any other trustee comments regarding any of the items under 3? Any public comment?
There is no public comment.
I think now would probably be a good time to take a break and gear up for the next few items. So if we can take a break until 10 a.m. Thank you. Thank you. We'll call back to order the July 19, 2023 Board of Retirement meeting. Takes us to item number 4, discussion and possible action regarding the 2023 actuarial audit of June 30th, 2022, actuarial valuation. If you would do the introductions, Executive Director.
Thank you, Chair Cromer. As the board may recall, periodically, roughly every 5-6 years or so, we have an actuarial audit performed, which is reviewed by an actuarial company that is not our consulting actuary to review the work of our consulting actuary for reasonableness and best practices and things of that nature. So with us today is Graham Schmidt with Chiron, and they produced our audit report. They were also the firm that produced the last report 6 years ago. Chiron reviewed both the annual valuation for the year ending June 30, 2022, and the recently adopted experience study that reviewed our 3 years of data in development of our assumptions. So I'm going to go ahead and turn it over to Mr. Schmidt.
Telling Jim, the first time I came up here to deliver the results of an actuarial audit was almost 12 and a half years ago to the day, and I can remember that very easily because my first child had been born, and this was my first meeting after my first child was born. I was a lot more awake on the drive up today than I was the first time I delivered the results. So you have a much perkier me, I think, than the first time I was here 12 years ago. But just a little background, as you said, Chiron, we are an independent actuarial firm. We are the actuary for 6 of the other counties within the 1937 Act, and I've done audits for 12 of the other systems. So we are very familiar with these plans. Want to give you the headline right away. The audit was very clean. As compared to the one 12 years ago where we had some issues that we were looking at, this time around we found no significant issues with the calculations. We found all the recommended assumptions that Siegel had recommended to be reasonable. So big picture, very clean audit. We do have a couple very tiny technical issues that we found as part of reviewing the coding and the plan provisions, and we'll get into those. 1 or 2 tiny comments about some of the proposed assumptions. But other than that, we're really finding not a whole lot to comment on, so hopefully this presentation is pretty brief for you. If we can jump right into the results, right? So jumping to page 3, table 2-1, shows our comparison of the results of the actuarial valuation as of June 30th, 2022 to Siegel's results. So as part of this project, what we are doing is we independently collect all the information that you provide Siegel as part of the actuarial valuation. We program our models independently, we run it through our valuation software, we collect the assets and everything, same asset values from MCERA, and we really want to thank both Robert and Judy in terms of helping us with that project. Right there, we got it. Oh, nope, there we are, page 3, that's okay. So we really are completely independently verifying the results of this valuation, right? We collect data both from your plan and from Siegel in terms of what they use. We compare that information, and then we run it through our own systems. And what we find is that our comparison is almost lockstep with theirs. We are generally, with these audits, trying to get within 5% of the overall liabilities, the overall contribution rates. We are much, much closer. In this case, our comparison of the liability to Siegel's was within 0.5%. Our comparison of the unfunded liability is less than 2%, and it's normal to see a slightly larger difference on the unfunded liability because the asset amount isn't actually changing at all. And then when we look at our funded ratio, the funded ratio comparison, again, is spot on. Contribution rates, that's also frequently a place where we're trying to get within 5%, and we're even closer. We're within about 1% of Siegel's calculated contribution rates, not just for the employers as a whole, but for each of the individual employers and each of the individual tiers, and the member contribution rates as well. So our match was great, which means that you really can rely on the results that Siegel put together. This ensures that the calculations that they are making are correct and that they are correctly interpreting the plan provisions, right? The provisions of the plan are matching up with what their modeling is showing. diving a little deeper into those results, if you go to the next page, table 2-2, we show the liability, which is also the funding target, right? These are the assets that you would like to have on hand to cover the benefits that members have already earned. When you look at that comparison, even within each of the individual tiers, we're within 5% on all groups. Most groups were significantly closer than that. We're a little bit further away, just under 5% away for the safety tier 3 and probation tier 3. That's not unusual to see a slightly larger difference as a percentage when we're talking about new tiers for members that don't have much service on average, right? These are your pepper groups. On average, these members have a lot less service than the older tiers. And what happens within the different valuation systems is when it comes to, calculating when somebody was hired or their age at the valuation date, we use rounding. And some programs round things in different ways than others. And when you're talking about small amounts of service, if that's getting rounded up or down for a specific individual, it can have a larger impact as a percentage of that member's liability. But when you look at the dollar amounts, you still see that we're very close in terms of all the results to Siegel's. So we don't see any problem with having slightly larger percentile differences for some of those less experienced tiers. And again, in total, we're off by only $4 million on a total liability of over $800 million.
Graham, could I ask a question?
Sure.
Over time, as we get more experience with those tiers, you would expect that potentially gap to close between your number and the...
Yes.
Okay.
And the more important thing for those younger tiers, where the liability is not that large yet, is when you look at the contribution rates, right? Because that is the total benefits, not just the benefits that they have earned, but they expect to earn. And to that extent, when you're talking about an entire member's their entire career, the rounding doesn't matter as much, right? Whether you're at 29 or 30 versus 1 or 2 in terms of the percentage differences. And so you can see that when you look at the contribution rates, and you see that our match, even for the pepper tiers, is very close. That takes us right to the next page, 2-3, where we show the comparison of the employer contribution rates for all tiers. And again, here we're within about 2% on all tiers, so a very close match in terms of Siegel's contribution rates and the contribution rates that we calculate. Again, those contribution rates are made up of two pieces. There's the normal cost, the cost of the benefits that members are earning this year, plus that payment to pay down the unfunded liability. So when you add up those payments, again, our comparison of our results to theirs are very close. We then also talk about our verification of the employee contribution rates, right? So for your legacy members, those rates are set in a set of formulas in statute, something like for your general tier 1 members, they're paying an amount that would get them a 1% of pay benefit at age 60. So we have to do calculations at each entry age to figure out what would that rate be. And we hit that to the 100% for all of your active contribution rates. We also verify the COLA calculations, so the payments that the members pay towards their own COLA came up very close on those as well. And then the PEPR members, they contribute half the normal cost. Because we were very close on the contribution rates for PEPRA, it follows that we got very close on those rates as well. So in summary, the results of the valuation, super clean, super close match. Want to talk about just a couple things that we did find in our review of the coding. One of them has to do with entry age. So we use different entry ages for different purposes, right? This is the age at which members are hired into your system. You use something called the entry age normal funding actuarial cost method. It's the same method that's used by all systems in California, basically. It's required under the government accounting standards that you use this methodology. And we match with Siegel in terms of how they calculated the age at which members are hired. That's why we were able to match their normal cost calculations quite close. They used that same entry age when they were looking up the members' contribution rates, right? If you're aware, your legacy members, your non-PEPRA members, the contribution rate that they pay is based on the age at which they enter the system, right? And the lower that age is, the lower the contribution rate. The higher that age, they pay a higher contribution rate. And that's because when you hire somebody at a higher age, you have a shorter period of time to fund that benefit. Yes, they'll receive a lower benefit in general because they're not going to have as many years of service when they retire. But because you have a shorter period of time, less time for that money to earn interest and investment earnings, like your friends were just telling you in the prior presentation. So it usually costs the system a little bit more. And one of the unique characteristics of the 1937 Act systems is that if you went to work before you came here with a reciprocal employer, like CalPERS or another 1937 Act county, one of the benefits that the members receive from that is they get to use the age at which they entered that other system prior to coming to your system in setting that member's contribution rate, right? So if they were hired here at age 40, but they worked 10 years previously at Sonoma County, where they were hired at age 30, when they come here, that member contribution rate is going to be based on age 30, not age 40. So that member will pay a lower contribution rate. Siegel didn't actually get that information from you in terms of members that came in with reciprocity. They didn't get that information on those earlier entry ages. You do have that information in your system because we were able to get that from Robert and Judy. So we actually went ahead and recalculated the results using those entry ages with those reciprocal employers. It had a very minor impact on the results, right? Because it's not everybody has reciprocity when they come in. If we used those other ages, what it does is, on average, it's reducing the employee contributions for some small subset of the members, which would have increased the employer contribution rate slightly, right? If the employees are paying a little bit less, the employers would have to make up for that difference in the normal cost calculation. And when I say small, I'm talking about 0.1% of pay overall, right? So it's not a huge item. We alerted both MCERA and Siegel to that issue. They issued a letter in response that says they'll try to collect that information going forward. So it should make their calculations a little more accurate in terms of what are the contribution rates that those members are actually paying, okay? It doesn't mean that the members are paying an incorrect rate, right? They are supplying your system with that information. You are charging them the rate that they should be charged based on their entry age with that other system. It's just when Siegel does their actuarial evaluation, they weren't picking that up, okay?
And the population that this affects is not large. It's, I believe, around 40 individuals in the last valuation. And as Graham said, MCERA is giving them the correct age-weighted rate. It's just that that age wasn't used for the valuation purpose.
So again, minor issue, easily corrected going forward. The other tiny thing we found was in terms of you have members who are recipients of benefits through a domestic relations order, right? So this is the alternate payee in a DRO. I'm sorry, not trying to be an actuary and speak with too many acronyms, but so a domestic relation order, you split the benefits between the member and the alternate recipient. Siegel was valuing the benefits payable to the alternate payee over the expected lifetime for the alternate payee. And that's fairly normal. That does happen in a lot of systems. This is something that I was told actually came up in your VCP process. The way your standard order works currently is that that benefit is actually supposed to be payable over the lifetime of the member, not the lifetime of the alternate payee. So if the member passes away before the alternate payee, that benefit's supposed to stop. Well, why does that matter in terms of the liabilities? Well, it turns out that most of the alternate payees, at least the ones that are receiving the larger benefits, are significantly younger than the original member, right? So that member has a shorter expected lifespan than the alternate payee. Siegel is valuing it as if that benefit payment is going to be paid over a longer period of time, which results in a slightly higher estimate of the liability. So we rerun those calculations assuming that the benefit would be payable just for the lifetime of the member, and it increased or reduced the liability, by just over $1 million in total, and over a liability of over $800 million. It's not a material item. We were also told that it may be the case that some of those benefits may be recalculated and then they will be paid over the lifetime of the alternate payees.
At this point, we are waiting for the IRS to review the updated VCP application, and we made a change to how we expected to correct those deficiencies in the DRO process with them, and we're waiting for the IRS to respond and tell us if they will accept our new proposed methodology. Once we get that information and get it all sorted out, we'll be able to provide better information to the actuary regarding the division of benefits, because there will be some individuals who will remain, as we say, a shared benefit where the payment to the alternate payee terminates upon the death of the member, and there will be others that get converted to an option 4 type benefit where the benefit will continue on for the life of that beneficiary. This is really in part due to our improper administration of DROs that was part of the VCPA application, and I think that's probably enough to cover it, but if you want more information, please let me know.
Thanks for clearing that. Suffice to say, even if there are changes that get made to members' benefits and to whom they're payable over what period of time, the impact overall will be similar to what we identified here. Because when you make those adjustments, basically the plan tends to make those adjustments on what we call an actuarially equivalent basis, right? So the value paid to the member and the alternate recipient remains the same regardless of whose lifespan over which you're paying it. So in terms of the impact from what we discovered in our calculations, that impact won't be any different depending on what you do. So that takes us through really all of the technical issues that we identified as part of this audit. In addition to verifying the plan overall, all of the calculations as a whole, we also looked at individual member calculations, right? We asked for some specific test lives. We dug even deeper. Again, we were able to match on all of those individual calculations as well. That takes us to assumptions, and I know that's probably been where you guys have focused your actuarial discussions over the last few months. I know there was an initial presentation, and then you were reviewing that information. All of the recommendations that were in Siegel's investigation of experience we found to be reasonable. We did not do the same kind of parallel valuation of the experience study that we did on the valuation, right? We did not recollect the data for the last 3 years and analyze that separately. What we did was we looked at the information that Siegel presented in their report, looked at whether we thought it supported their conclusions, and then we also compared it to our understanding of other similar systems, which, we work with a lot of very similar systems. We have a sort of a large universe of plans that we can look at and say, okay, does this recommendation make sense in light of what we know with these other systems? We have one small comment when it comes to those assumptions. And again, this is not one that would have a significant impact on the contributions or the liabilities going forward. It has to do, again, with reciprocity, which is frequently an issue when we look at these systems. So Siegel has an assumption about when they assume somebody who has a deferred vested benefit will start receiving that benefit, right? Somebody who leaves after 10 years of service either goes and works for another employer or doesn't. They're going to eventually qualify for that retirement benefit and start receiving it from MCERA. Their assumption about when that occurs for your safety members is age 54. And they don't distinguish based on, across all tiers. They're just assuming age 54 is when safety members will commence their benefits. We think that is probably reasonable. It's consistent with what they've seen in the data. However, we generally recommend that you look at that assumption separately for members who have and have not established reciprocity after they leave here. The reason for that is somebody who does not go on to establish reciprocity somewhere else. If you're a safety tier 2 member, you have no incentive to postpone your retirement past age 50, right? You get your 3% at 50. By waiting till age 54, you would be giving up 4 years worth of benefit payments and COLAs that you would be due otherwise. And what we find is that most members are savvy enough to not do that, right? So generally, when we're talking about assumptions for people that are going to work for another employer, we would say face 3 at 50 safety members especially, use the earliest age that they're eligible to get that full benefit. Having that assumption could increase the liability slightly. The issue that Siegel identified for you all is that the information they receive on who actually is working for a reciprocal employer
is maybe not the most reliable, and you're doing some data cleanup in that area to try to figure out, which members have established reciprocity elsewhere. So we understand why Siegel has some concerns about applying different assumptions when they don't actually know, does this member have reciprocity or not? The one recommendation we have in our report is, even if you have no idea if somebody has reciprocity or not, they have separate assumptions about what will happen for members who are currently active, right? So they have an assumption about if somebody is active now, there's some likelihood that they will leave, get a terminated vested benefit, and then they may or may not go and establish reciprocity. So for those members, at least the active members who are assumed to get reciprocity in the future, we would say for them, at least count them as a 3 at 50 member. Now again, this is not going to apply to very many people. Most of your safety members work until retirement. So we're talking about a subset of a subset of a subset, and it doesn't have a huge impact on the liabilities. But for actuaries, we got to nerd out on something, got to find something when we're kicking these tires, so that's what we came up with.
Mr. Schmidt, I have a question and hopefully maybe a little clarity. Are you talking about systems that offered in a tier prior to the current one, prior to PEPRA, that had 3 at 50? Because we have not, as Mendocino County. Safety tier 2, it's 3 at 55.
Don't you have a small group that is your tier 2 safety and probation?
3 at 55.
Is
It
it
went from
3
3 at 55 to 2.7 at 57. So we have never had that in Mendocino County. There's
Okay.
other CalPERS systems in this county that have 3 at 50, but we do not.
All right, I'll have to check my notes.
Yeah.
But
That's why I was surprised at the 54, because actually that, for most tier 2
They would
members,
wait
would
till
be
55.
before their retirement age.
okay, and what your tier 1 was not the 2 at 50 tier, right? There's no.
I don't believe there's a
You have some
contributing
deferred
member in
members, but I
tier
don't think
1
you have
anymore.
any active members left.
There's
in.
no active members in
Okay.
tier 1 remaining.
I'll have to go back and look at that, but I appreciate you letting us know that. Okay.
Can I nerd out on something else?
Sure.
Okay. So if I read the report correctly, you're saying that the threshold for achieving the target is within 5%.
Right.
Okay. And then in the report, you've given us a couple different tables, and one of them that I'm kind of zeroing on is table 2.3, which shows the employer's contribution rate and combined all categories, general, safety, probation, it's 37.18, and it's you came up with that's within 1.2% of what you came up with, but it was a little higher from the employer. What we have with Siegel.
Yep.
Now, if we look at the fact that the county, the employer, is contributing just under $4 for every $1 that the employees are contributing, I don't see a corresponding table 2.4, which might have shown how precise are we on accurately collecting the correct amount from the employees. And so if we use I know that we're combining numbers here. When we combined tiers, there's different numbers of people in each tier. There's different numbers of, so, but just very, very rough numbers. If the employer is contributing almost $4 for every dollar the employees are contributing, and the employer is contributing I know this is not accurate, but 1.2% more than you came up with, then correspondingly, the employees are contributing roughly 4.5% less, still within the 5%, but about 4.5% less than you would have come up with. So I'm just wondering, could we see that table 2.4 that's not in this document?
So the answer to that is actually on page 6. It's not actually a table, right? Because first of all, we do those comparisons at each individual entry age, right? And as I said, the basic rates, the rates that are not associated with the COLA, right? Those we matched to the penny, basically, right? The rates that were within the COLA, we matched close enough, and Siegel applies basically a load to cover the cost of the COLA for the employee rates. Again, we match those total contribution rates at every entry age within 2%. Versus Siegel's amount. So for each member, our rate that we computed was within 2% Not 2% of pay, 2% relative to Siegel's rates.
Okay, so the county was contributing 1.2% above. Were the employees contributing 2% below?
No. Our rates were slightly, I believe they were in the same direction because our overall estimate of the liabilities were slightly lower. Right, sorry, slightly higher.
Graham, if I might, I personally found the table 2-1 on page 3 can in part address this question on an aggregate level, because it does talk about the employer normal cost rate. The normal cost rate, certainly for PEPR plans, is split 50-50. It's not quite a 50-50 split for the non-PEPR plans, but you can see that if the normal cost rate here for the employer is coming out at the aggregate level at 10.76 or 10.77, your employees would be paying essentially that same normal cost rate because they're only paying the normal cost. They're not paying anything towards the UAAL. And that's kind of where I saw this on a global aggregate basis as opposed to the individual ages for the specific tiers.
Right.
I'm sorry if I interrupted.
No, that's a good point. The comparison really for member rates is focused on that normal cost calculation, right? The unfunded liability is completely paid by the employers, right?
Yeah, we're too familiar with that.
Are you on the board of supervisors?
Yes, and I think it's what's wrong with pension systems in California and the United States is it's not equitably distributed members and the plan sponsors. But yes.
So we have a lengthy conversation in that area, but safe to say the comparison you're looking for between our costs and Siegel's is really focused on those normal cost rates, which again, were very almost identical on the employer side. And again, hit that to the basis point as well for the basic member rates. And we were very close on the COLA rates as well. So we're not seeing, the difference is much, much, much less than 1.2% of pay. We're talking about 2% on a member's contribution rate. A member's contribution rate might be, 10% of pay. So we're talking about, something considerably less than 1% of pay difference. Does that answer your question?
And if I might point out, as far as our membership, roughly 3/4 of the current employees are in those PEPR tiers where normal cost is absolutely shared 50-50, and that only leaves about 25% of our currently active employees who have a slightly different breakdown where they're paying a little bit less than a 50-50 split.
Just want to go back to the reciprocity thing too, and I had forgotten to mention this. The reason why we think it makes sense to look at those groups differently, it doesn't even have to do with whether or not you're paying a 3 at 50 benefit. When they establish reciprocity, they may be going to a system that does. And in order to claim that reciprocity benefit, you have to retire from both systems at the same time. So those members have a much higher incentive to leave at an earlier age. And in general, you have more incentive to wait when you have reciprocity, right? Because you are continuing to get pay increases at your other employer. So even in systems where they don't have 3 at 50, we have seen differences in behavior where members who have reciprocity tend to retire later because they're still working for another system where they're getting pay increases.
And Judy's done a lot of work on the actuarial data. Those, we plan to have a release to our pension gold system later this month, and we will be providing more detailed information on reciprocity than what we had provided for in the past. So certainly we'll have more information in the next 3-year experience study on the reciprocity issue to make the valuation more reflective of what we see.
And just to wrap up, I know and I haven't talked about this at all, discount rates, inflation, COLAs, anything like that, right? And I know that you've spent a lot of time on that over the last, this summer and previously. We fall into a trap sometimes of this illusion of precision, right? That we know that the assumption should be 6.5% versus 6.75%. And one of my clients gave me an example recently that made a lot of sense to me. It's if you got your 401k statement a year from now, and it said over the last 3 years you'd earned 6.5 versus 6.6 versus 6.7, would that affect you a lot? Would you be surprised, or would that impact you emotionally? Probably not, right? We're talking about relatively small differences. Now, it certainly has an impact on cost, right? Using a contribution rate of 6.5 or assumption of 6.5 versus 6.75, it does have an impact on the amount that you're paying now, but ultimately, the assumptions aren't going to determine the cost, right? What you actually earn is going to determine the cost. So,
However, the caveat to that is if you lower your projections of what you're going to earn, then you lowered your sights for what you're attempting to achieve.
yes.
And I've seen the process where we lower our assumptions and then we come in with the financial advisor say, well, we can meet your lower returns. We think we can achieve that.
Right.
And so it's a self-fulfilling prophecy in some regards when you repeatedly lower your long-term investment target and you then de-risk the fund by putting money into things like bonds that earn almost nothing. And now you've got to rely on the rest of your portfolio to actually achieve the target.
Right. I mean, that's the age-old chicken-egg conversation between the actuaries and the investment consultants, right? Is you give me a bogey and I can design a portfolio to hit that bogey, or tell me what your portfolio is and I'll tell you what, we think you can earn on it, right? So that's entirely true, that the way you frame that question can in some ways affect those investment decisions, right?
After all, it's just the employer that just has to find more money in the end to
Well,
backfill it.
and as you said, in terms of that shift in cost between the members and the employees, members and the employers too, lowering that discount rate does increase the contributions that the employees have to pay in as well, right?
But it's negligible. And it's almost all on the employer. And then the employer has no money for salaries because it's all going to benefits.
So suffice to say, just in terms of our review of those recommendations, they are reasonable. They are consistent with what the investment consultant universe is saying is a reasonable expectation over the long term, specific to the inflation assumption. However, the one statistic that you pulled out is the one that I think actuaries reference most frequently, because we're not the experts on this, but if you look at the consensus of the market and you take that from that break-even rate between tips and treasuries, and it's somewhere between 2.25% and 2.5% over 10 years or 20 years, and it's been pretty consistently there. Even when we had those spikes in inflation last year, that number really never got above 2.6. So the 2.5%, range is certainly reasonable. And then doing what you did in terms of keeping maybe a little higher expectation on those cost of living increases, in spite of the fact that you have the cap. I mean, we've certainly seen inflation in the West be higher than other parts of the country for some period of time. And I aware you did separate yourselves. You're no longer using that Bay Area index, correct, for setting those COLAs. You're using the Western region, but even that has exceeded the national average over periods of time. So I think it makes sense to have a little bit of conservatism on that assumption. And it's weird to think that an assumption of 2.75% on inflation is conservative, but it is if you look at the other data. So again, those were our thoughts on the assumptions, but I'm definitely happy to answer any questions.
Vice Chair Shoemaker.
Yeah, I've got
On mute, please.
2 lines. Hopefully they're reasonably short. The issue around the retire at 50, retire at 54, lose 4 years of benefit was shocking to me to read, because I always thought if you retired later, your benefits just accumulated and they got divided up over more years. Not at 50 or 55 or 57 and a half, that's what you're going to get. You might as well get out now. Is that not the case?
So it depends. If you've established reciprocity, one of the benefits for deferring retirement is that your benefit, you worked here for 10 years, you do a lateral transfer to some other agency, right? If you don't establish reciprocity, and let's say you're a 3 at 55 safety member, if you retire at 55 or you retire at 56, You get the same benefit. In fact, if you retire at 55, you're going to get a higher benefit than you would if you retire at 56 because you will have gotten a COLA for that first year after retirement. Your benefit doesn't change. It's based on your final compensation when you left MCERA, right? And it's based on the service that you had earned with MCERA. Now, the formula can change depending on the age at which you retire. So with the PEPR formulas, right, those start at, like for the general members, that starts at 1% at age 52, and it goes up by 0.1% per year. So you do get a higher multiplier if you retire at a later age. But some of those safety formulas, again, for year 3 at 55 members, that highest multiplier comes at 55. It doesn't go up if you wait till 56, right? And some of those members that are a safety member that goes and works for another agency that does have 3 at 50, at that other agency, their multiplier is not going up past age 50. Why you would postpone retirement, or why there's more of an incentive to do so when you have reciprocity, is if I do that and I continue to get pay increases at that other agency, then my benefit will go up, right? So if I went somewhere and they had like a longevity bonus after 20 years and that was pensionable, I would get that in my check from MCERA as well, right? That would get included in my final compensation. So that's why our recommendation is generally to look at those assumptions separately. When are people likely to retire if they have reciprocity versus if they don't have reciprocity? Because the people that don't have reciprocity have much less incentive to wait to receive that benefit.
Something I might come back into the office and talk about. So the other one, and this is auditors, and audits are super important in governmental work. Lots of stuff is based on them. Corrections are needed. If you took your report and you took Siegel's report, does one have more value over the other?
That's a trick. It's a
It's a
tough
trick
question to
question.
ask somebody who would love to work for your plan someday. I think that all of us in the actuarial profession have, I think, gotten better about not just providing you the bare minimum information you need in terms of, here's your funded status today, here's your contribution rate for next year. We are all trying to do a better job of helping you understand so you can manage the risks of the plan going forward, right? And there was a change in the actuarial standards of practice a few years ago where it said that for some of these things, you have to put some of this information about risk in your valuation reports. We have tended to include a lot of that information, including forward-looking projections, in our valuation report. Siegel they provide a lot of that same information in a separate report, right? They give you a risk report, which is separate from the valuation report. But if you combine those documents together, you're getting most of the same information. Okay. So you asked us specifically about the valuation report. Well, ours might have some slightly different information, but Siegel is also presenting that information in another format.
And that was not anything about auditors at all. That was just, we have lots of discussions like that here.
From what I've seen, your firm and Siegel are the two primary actuaries working in California for the 1937 Act counties. And so one of the bigger risks that was identified in recent years that has been hopefully corrected is the fact that employees are living longer, the public is living longer, but specifically the government employees, because they have health care, a number of other things, that they live longer than the general public population. Plus, if they've reached retirement age, they actually survived those 30s, 40s, and 50s and didn't die on a motorcycle or something. Mm-hmm. So and that hopefully has been corrected. And I know that one of the things we always ask Siegel is, are you factoring in any growth in the expected longevity of them based on anything you're seeing? And I can't remember what study they were using. It was maybe a few years back that they were using a study specifically for government employees. Yep. And is there anything, whether it's that issue of longevity, that has added unfunded liability to pension plans in the last few decades because it was underestimated? Or is there something else that you see on the horizon that you think is a potential risk for pension funds that we may not know the answer to, that's as it wasn't being documented 10, 20 years ago accurately on longevity?
So that's a great question. And that actually was one of the big subjects of our prior audits. So this is the third audit we've done. 2 cycles ago, we made a recommendation that you start taking into account those future improvements in mortality. It's called generational mortality assumptions, right? And that was a recommendation that we made. That has been adopted by this plan, right? So at the time that we did the first one back in 2011, you were not using those assumptions. You now are. The other thing that it's kind of a technical thing, but ends up being kind of interesting, and it's how you analyze that experience. So, right, you look at those broad public sector tables, right? Because you're not large enough to develop your own assumptions about mortality. What you do is you compare your experience to one of those general tables and you adjust it, right? You adjust it for the fact that, okay, on average, our members seem to be having, slightly higher rates of death or slightly lower rates of death. So we're going to make adjustments to that standard table to fit our population a little bit better. And we may not adjust it all the way to match our experience because we're not huge still, right? But you might want to get part of the way there. And the recommendation that we made as part of the last audit was when you compare your experience to that standard table, the one thing you really should be doing is weighting that experience not based on the number of people that live and die, but based on the benefit amounts, right? That you should weight the experience based on how much if you look at the total value of benefits that are there at the beginning of the year and the total benefits that are being paid out at the end of the year, not the number of people that are there. And the reason for that is that members with higher benefits tend to live longer, right? So if you analyze it based on the number of people that live and die, you could get that number precisely correct. But you might be underestimating your liabilities because the people with the larger benefits are the ones that are not dying, and the people with the lower benefits are the people that died in that year. And that was one of the recommendations that we made at the last experience, when we analyzed the last experience study. We said, you really should be, when you're comparing your experience to this general table, you should use benefit weighting. And Siegel did adopt that practice with this most recent experience study.
Okay. And that conforms to what I've heard about the general population, that generally speaking, the higher income people are the ones that are experiencing greater longevity than the population as a whole, and you would expect the same within a subset of a pensionable population, that generally speaking, the higher income folks are going to live a little bit longer than the lower income pensioners.
Right. Siegel made a similar change that we had recommended at the last audit when it comes to retirement rates as well. At the last experience study, Siegel's assumptions about rates of retirement were based on age, right? What was the likelihood of somebody retiring in the next year? You would just have a table based on ages. And what we recommended then was don't just look at age and something else, like age and service, right? Because again, you could predict if you could be correctly predicting the percentage of 55-year-olds that are going to retire in the next year, but if it's the 55-year-olds with the higher benefits are more likely to retire sooner because they can afford to, and people who have lower benefits aren't going to retire until later when it costs the plan less, you might be underweighting the liabilities. Siegel, again, we commend them that they adopted that approach for this experience study. You have separate retirement rates now for members with more than and less than 30 years of service for your general members.
Okay. Any further trustee conversation, comments, questions? I understand, Executive Director, that we did receive a letter response from Siegel. Is there anything that you wanted to cover in that under 4A?
Thank you, Chair. We did provide Siegel's response. As they mentioned, we will start providing entry age for the folks who have incoming reciprocity. We will also be providing, once we resolve our issues with the VCP, and the alternate payees better information regarding the benefit to the alternate payee, whether or not it's a life benefit or not. But Siegel did indicate that it was not an extreme difference, that using the life of the alternate payee was a reasonable approximation. And for the deferred reciprocal members, again, I expect this will improve because we are providing more additional information on reciprocity for all of our membership groups, whether it's active or deferred, and they can utilize that in experience studies going forward.
Thank you. Do we have any public comment regarding item number 4?
There is no public comment.
I would say thank you very much for the presentation and us taking the questions we bring to you. And to me, this is very satisfying against the discussions we've had about our actuarial studies. The information you furnished really helps understand each aspect of it. Thank you.
And sorry, I forgot to also thank Andy and all of the folks over at Siegel. They're very, helpful in completing this study, provided us all the information that we asked for. And again, want to thank Robert and Judy too for their assistance as well.
I don't believe we need any action other than received and filed. Thank you. Appreciate your time, Mr.
Thank
Schmidt.
you.
Takes us to item number 5, MCERA cash flow presentation. Would that be Financial Investment Officer Revelis?
Yeah, trustees, we've got a new report that we've been bringing for, this would be the second year. First one was last year. And it just goes over cash flow projections broadly for the system for the next 2 fiscal years. Judy, are you able to put that on screen? It follows the same format as the previous year. And so we could go right to page 2, which shows since 2012, contributions, benefits, and administrative costs by the fiscal year. And we've also got a line there that shows the contributions going up. So you can kind of see the tick ups that happen every 3 years as a result of the actuarial studies, the experience studies where new assumptions were adopted. Doris and I sort of debated whether or not there should be more of a jump in the 2025 year. I may be a little more optimistic on what the 23 valuation is going to say, so I opted not to include a large jump there. But you can see the trend that benefits are increasing, contributions are also increasing as the system grows. On the second page, third page here, we've just got a table of the chart that was on page 2. So these are just the numbers. Again, there's a number of assumptions behind the scenes here. Fiscal year, when I made this report, 23 wasn't quite done at the time. And of course, 24 and 25 are in the future, so we don't really know where those are going to pan out. But broadly, you can see probably the most important line here, I would say, is the net cash outflow column. And that's the gap between benefits and costs. On the next page, we've got monthly benefits expected by month, and we can see the same broad trend in the light blue, in the light purple bars there. Of course, the refunds are in the black. We don't know those. I'm not projecting out necessarily refunds. These are just a combination of benefits and refunds going into the future. On the next page, we can see the plan sponsor contributions. They're broadly following the same trend that we've seen. These are based on roughly a 3% increase in covered payroll for all the plan sponsors in each additional fiscal year.
Robert, before we move off on that one, every now and then you see a big spike where it looks like the employer contributions are much higher on a dollar received. Those are the months in which there were 3 paychecks issued.
And then the shorter bars there are accrual months. So you can see the first purple bar is relatively short, but the blue bar just to the left of it is higher. That's because of the way the county accrues their payments, their contributions.
If you add them together, it'd be equivalent to the lines around them, right?
Yeah. Well, they'd be a little higher because they are 3 payrolls buried in there. They would still be higher, but not quite as high. On the next page, we've got yearly administrative expense. This uses another 3% growth assumption. Our primary expense is payroll. I'm not sure how realistic it is to assume that all of our administrative expenses across the board are going to go up 3%. I think we're limited by staff. So this could be a little bit conservative in that it shows possibly too high of an administrative expense.
Well, so the county budget we just adopted, which had step increases for employees who were still eligible for a step increase, it had no COLAs for employees, but it had an increased cost for utilities and other expenses. It showed our budget that we just adopted grew by 6.5% with no COLA. So I'm not sure that 3% growth in expenses is, I mean, that's a lower growth rate than the county government as a whole.
The county overall budget includes more expenses than we would have. So this is based on our staffing and our usage.
Well, we have healthcare costs that are growing at 12% a year.
And those are being addressed in the Health Benefits Committee as well, which I sort of expected you to be in, but I guess you're not there.
I'm not invited. It's an employee bargaining team.
Oh, interesting. Suffice all that to say that I do expect these numbers on this page are a little bit higher than we will see in reality. Moving on to the next page, this is investment sales for operations. This is literally my own projections of how much cash we need to maintain a positive cash balance. The last few years we've been running somewhere between 10 and 8 million. The spikes in 2020 and 2021 are due to the additional refunds related to the VCP. The next page shows our comparison of cash to net position. The 2023 net position, I underestimated. I know that's probably going to have another $6 or $7 million on it. But it gives you a broad sense of do we have cash sort of laying around at year end? The answer is no. Although maybe we wish we did now that cash is returning, 4%, 4.5%, 5%. We still are running relatively cash low. And then the final page here shows our net cash outflow to net position. And again, depending on what column you want to focus on, you can see that we're essentially lowering that ratio over time as a function of primarily the growth in net position. We went from $343 million in 2012 up to about $665 million today.
And this is one of the measures that was introduced to the board last year as far as a maturity measure and whether or not a plan is sustainable. That measure says anything less than 3.5% negative cash flow leaves you in a sustainable position. So although our number of retirees and our benefit payroll continues to grow because we've had good growth in our asset levels, we can see that we're not increasing our negative cash flow, that it is actually decreased, and that's a good sign. And this is of no concern to the plan as a whole that we have negative cash flow, meaning the money coming in from employer and employee contributions being less than our benefit payroll that we pay out. But if you have any questions about that, I'm happy to discuss.
That's the end of the report.
Vice Chair.
When are the pension obligation bonds done?
I think it's 2027, and then and it's split between general fund and non-general fund.
Got it.
So it'll free up, I don't know, $5 or $6 million in the general fund, and we saw our non-COLA costs increase, I think, by an equal amount this last year. So it's nice to know it's there. It's not that significant.
Just looking at the blue line on page 1 where it sits, and if there were another, and I'm making an assumption that another $5 million put into the system.
There won't be $5 million to put in the system. We're running on fumes in the county budget. Our costs are increasing faster than our revenues. We won't have extra money to put in the plan.
And I would also point out, sort of to that point, that it's going to be very difficult for the county to make additional payments above and beyond what what all the plan sponsors are broadly required to contribute. Yeah, because it's multiple employer plan where costs are shared equally.
Got it. So what you're saying, Dan, is you do not believe in 2027 the money that's going to the pension obligation payments will be available to the county to utilize against the debts they have here?
It's not possible. We have a $7 million, we just adopted a budget, $7 million one-time funds used for operational expenses, salaries and utilities. Haven't done that during the entire time I've been on the board. Next year, our county contribution to the pension plan grows by another $3 million. If you assume all of our revenues were going to grow as fast as our expenses, we've got a $10 million structural deficit. It's pretty clear when you look at our revenues aren't growing as fast as our expenses, absent of COLAs.
Yeah.
So now you start factoring COLAs that aren't even we don't have money for. Do you think we're not going to approve COLAs? Our only option is to lay off people and eliminate positions.
So this is related, but not on the money. The work that's being accomplished around reassessments, catch up on those things and so forth, they aren't going to put, I understood it was in the millions of dollars.
County gets about 30 cents on the dollar. And so you bring in $15 million and maybe it's $5 million to the general fund.
Okay, thank you.
Any further trustee conversation regarding this item? Any public comment regarding item number 5?
There is no public comment.
Thank you. I don't believe any action is required on that item, so received and filed. Thank you for your efforts, Mr. Revelis. Number 6, discussion and direction regarding investment belief statement. Financial Investment Officer, Mr. Revelis.
Board, you have before you a proposed language addition to the investment policy statement, into the investment beliefs section, belief number 3. I've got a memo that talks about the background and information related to the addition, and so we're just looking for potentially board approval or discussion on the proposed addition and location of the addition within the investment policy statement.
The full investment policy, which incorporates these belief statements, is actually coming back next month for adoption. This is an opportunity to adjust any language or indicate if you would like it as a separate belief point as opposed to incorporating it into belief number 3. The language here was based in part on our past discussions with the board regarding their feeling about ESG, and we're looking for any direction the board wishes to provide, or if you would like to go ahead with the language proposed.
I think maybe Jeff would like to also say something about this. I don't know. Jeff?
I did get a statement added to Robert's memo that talks about it. I believe that the statement is consistent with your fiduciary duties. It's not obligating or requiring the system or its investment advisors to do anything in particular. It's just a factor to consider among other risk factors.
Thank you, Trustee Anderson.
Thank you. I appreciate that staff has been sensitive to the board's interest in this and has brought education and so forth and has brought options here. Just as one trustee, as I look at it, it's permissive language. I know there's a lot of discussion about ESG out there, but it really doesn't add anything from my perspective to the investment policy. And I don't know that there's any harm. It's just Jeff required of us performing our fiduciary duties because there's no requirements there. So I'm kind of, as one trustee, I'm just kind of ambivalent.
And we don't have to include a statement. It seemed like some board consensus to add something, and maybe this isn't strong enough. Our past experience has been that we allow the investment managers to look at risk associated with ESG, but we don't have an ESG mandate. We are not going to create any ESG mandate based on our discussions at previous meetings and those educational sessions. We can work on the language if you have some suggestions. We do not need to add it to the policy if you don't wish, and that's really the direction we're trying to get from the board is whether or not this meets what your intention was and you want to add it. If you don't want to add it, do you want to add something else? So I appreciate your comments, and you're right, it is on the general side and permissive, but it states no mandate. We obviously wanted to retain the board's fiduciary obligation and just sort of acknowledge the ESG issue, but we are certainly open to direction from the board here.
I note one word in this thing. Toward the end there, the financial performance of the fund can be consistent with the board's objective. That could be a should in the context of the whole sentence, or it can be a can. A should is more directive. A can is like, yeah, it can work.
I think overall where I'm at, is there an ambition from the trustees to add language regarding ESG in our investment beliefs? And if so, where should it go? Where they have it in item 3 or belief 3 or somewhere else on its own? And this was an item that was a part of the strategic plan and mentioned there, so I appreciate the staff bringing it forward to our attention. So if there's any ambition from anybody here today, I would like to hear it. Trustee Harris.
I was the person who wanted us to have some board education on ESG. We did. I don't feel I have to have it in the investment policy. I think it's something we already considered. It was not something that was part of our lexicon, and I was glad that we spent some time on it. That was all I was interested in.
Thank you. Trustee Jordy.
So I don't think we have to have it in. I don't see a harm in putting it in. I would support putting it in. I think I would just substitute the word alongside at the beginning, and I would just put it, instead of alongside, I would say looking at financial, economic, and other risks the board may consider. Because to me, it's trying to make sure that we're looking, as when we look for risks, and we're obviously looking at risks and we're looking at investments, I think these are areas that do pose risks to certain investments more than others.
Okay. Any further discussion? Do we have a motion to entertain regarding adding or not adding this? I guess we don't have to take action at all.
It would just be directions.
Okay.
We'd be happy to make those verbiage changes and leave it in the policy statement that will come back next month. Or if the board's pleasure is to not address it within the belief statement, we can remove it and come back with no addition to that section.
Or any input regarding trustee Jordy's suggestion?
That whole sentence would have to be rewritten, I think.
Trustee Anderson?
I would agree with trustee Harris. I think we've discussed it. I don't know that it's necessary to have it in our belief statement.
Okay.
So I'll take the position that we can leave it in as stated.
Without the ESG language?
No,
Okay.
as on the piece of paper, I would make a motion that we approve it included where it is.
So it sounds like it's 2-2. If someone wants to break the tie or something, or get a consensus of the board as far as whether or not to include this language when it comes back next month for adoption.
Trustee Harris?
I would ask for a motion. There was a motion. I would ask for a second or no second before discussion occurs.
I'll second the motion.
Thank you.
Trustee Harris?
In any way harmful, it just brings it forward. I think we're going to see a lot of this in the future, so I'm talking on two sides, but I would break a tie and say, let's put it in.
Well, if there's actually a formal motion in lieu of board direction, you're welcome to vote on that, and then we'll do whatever the vote indicates.
There you go.
And if it is voted in, it likely wouldn't have to come for next month's meeting if we
It's
just
going to
adopted
come
it.
next month's meeting anyway, because we have some other changes in the actual investment policy. The belief statements are just part of that policy, and we wanted to get a feeling for the potential verbiage, so we can finalize the draft that comes back next month with the other policy changes.
All right. As far as further discussion, I find the addition, doesn't sway me one way or the other, and it seems to be rather wordy to me, just to say that we can or could consider ESG, so I find it frivolous personally, but is there any further conversation regarding the motion and second? Go ahead.
I think that we might want to consider altering that can should.
Okay. We have,
Want to include an edit for that.
Is that an amendment to the motion?
it would have to be yours.
Well, she would offer an amendment, and I would accept or deny.
Okay.
Sure, that's,
Yes.
we can incorporate both language changes requested if that's part of your motion.
I accept the amendment.
And does the second have to do the same?
Yes.
Thank you. Any further?
So I'm sorry if I may interject. Are you going to actually take a motion on whether or not you want this in? Because it's only on today as to give direction, because it's supposed to come back next month. So if you're bringing a motion to take some final action today, the agenda item's not dressed up that way.
Yes, I'm sorry, it is as a discussion item only and for direction to us. So if we can boil down that direction and give us a clear path forward, you'll see this again next month.
Okay.
Do you feel like with the conversation you have sufficient direction?
As I interpret it, we will bring this back next month as part of the policy statement, including the two changes in the specific language requested by Mr. Shoemaker and Mr. Jurdy, and that it would remain the policy generally as written.
All right.
Well, I'm sorry to make this longer. I don't believe you should change the first line. Dan?
Excuse me, what?
Yeah, I'm just saying, I don't know that taking the word alongside out of that first line does not make a coherent sentence, first of all. I don't believe.
So I was suggesting substituting looking at for the word alongside. So looking at financial, economic, and other risks the board may consider, because I think these are a form of risk.
Okay. Sure.
Okay.
All
Thank you
right.
for the direction.
Direction provided for item number 6 takes us to item number 7, discussion regarding the Historical Benefit Review Project. Executive Director Rentschler.
Thank you, Chair Cromer. we have the updated report. The most recent months for June and July reflect a total of 10 corrections, so I don't think we had the report ready in time for last month, so I wanted to show. Those are the months in which the corrections are to be processed. The member was notified the month previous. So we are making slow but some steady progress now that work on the correction project has resumed. Included with the report was page 3, just to give a reminder of what the errors consisted of. So the error number across the top of page 2 is identified on page 3. If you have any questions, I'm happy to answer any specifics.
Thank you. Yes, Trustee Anderson.
Just real quick, informational, presuming success with the VCP, about how many outstanding corrections are there? I know you're making the progress you can with the staff turnover and so forth, but just curious how many are remaining.
My estimate is that outside of things that could potentially be resolved with the IRS accepting our new proposed corrections, is that we have in the neighborhood of 80 to 90 that we're working on that would fulfill the entire project. If we enter into negotiations and then come to an agreement with the Internal Revenue Service and get a compliance statement issued, we have 150 days from the issuance of any compliance statement to wrap up any outstanding issues. So we are continuing to try to work on this to make sure we don't need to ask for an extension once we get that far along in the IRS process.
Any further discussion or comments? I'll remember this time any public comment regarding this item.
There is no public comment.
4%.
We'll consider item number 8, received and filed. Takes us to item 9, discussion regarding board work plan and strategic plan calendar. Executive Director Rentschler.
Okay, so we're moving to the board work plan and calendar. Item 8 was a receive and file. If you have any questions on that item about unrecovered payments, I'm happy to address those. So the work plan shows our progress to date on the strategic objectives set in the 5-year strategic plan of the boards. I did want to mention that we will be bringing additional action items. You'll see some updates to this as we identify more specific action items for the next coming year in support of those objectives identified as part of the 5-year plan. We have made some good progress. There are a couple of things that are showing as a yellow light, and we're working on those risk metrics to bring to the board, and we do expect to bring something within the next 6 months on a couple of those items. And the board calendar reflects some updates for the coming months. The board's rolling calendar, including you'll see an absence in the last 6 months on this calendar of any educational sessions. Rather than schedule some items at this point, I was going to hold off until I got the results of the board's performance evaluation, the board's self-evaluation, because that does include questions on an educational needs assessment that we would use in developing programs for in-house educational sessions that'll be part of the strategic plan. As of right now, we only have in-house educational scheduled through December, but we haven't scheduled anything for the first 6 months of next year. If you have any questions regarding that, I'm happy to answer any questions.
Thank you, Executive Director. Any comments or questions regarding item 9?
There is no public comment.
Thank you. We'll consider item 9 received and filed, and I misspoke. The prior item was 7 received and filed, so I will call item 8, discussion regarding the annual unrecovered benefit overpayments and underpaid contributions report. Executive Director Rentschler.
Thank you, Chair Cromer. This report is actually required as part of our error correction policy that at least annually the board is informed of any payments deemed unrecovered or underpaid contributions. This report does not reflect those corrections of overpayments that were included as part of the historical benefit review project, because those are reported monthly in which those corrections are made. We did have a instance where we had a significant overpayment of benefit because payments continued after the death of the member. And we described the situation and how we hope to mitigate the potential for that in the future. This was, it appears to be an incident of fraud based on a surviving family member who has now subsequently also passed.
Oh,
Any trustee conversation regarding this item? I do appreciate.
I guess my
sorry.
question is, what is our strategy to mitigate that in the future? Are we, in other words, are we putting, if, for example, the person who allegedly committed fraud, if their estate has a home, are we placing a lien on the property?
Yes, we would pursue that. In this case, it does appear that there is no estate. The member and the member's relative actually do not own any property. We've already checked into that. It does look like this is truly going to be unrecoverable, but we're continuing to search on that to ensure that there is no estate or asset that we can lay claim to account for or recover part of that overpayment. As far as going forward, we already use a death audit service, but of course the death audit service is only as good as identifying deaths that have been reported, and our member's death had gone unreported. But as far as what we will do differently, we were already in the process of discussing doing what some systems call an alive and well letter or a benefit affidavit that we would send out to either all members or a subset of members that they would need to provide a notarized signature to ensure that they're still alive and eligible for continued receipt of benefit payments. We will probably implement that process starting with the age groups that are higher in age and deemed to at more risk and likelihood of passing, to help ensure that they have proven that they are alive and eligible for receiving benefit payments.
So this does seem tricky because the people who are most likely to be in that category are maybe quite elderly, and they may be surprised to get this letter for the first time. So it seems like it could be kind of a labor-intensive thing where somebody might have to call. I mean, I could just see people thinking it's some scam or, you know.
It could be problematic by virtue of the fact that we will be asking for a notarized signature, and for folks who maybe aren't driving, it may be difficult for them or to arrange a notary to come to them. We do understand that there's shortfalls in that process. Unfortunately, we do need some way of verifying that it was truly the member who signed it, and just allowing them to sign the form and send it back to us doesn't fulfill that requirement that it was truly the member who had signed it. So we are looking at what we can do to limit the inconvenience to our members, but still ensure that the data we get back is valid and that that member is alive and entitled to benefits. We have discussed whether that be allowing a residential nursing home facility to sign, co-sign with the member, or other options. But as it stands right now, the most secure method would be ensuring a notarized signature. But in order for the signature to be notarized, they usually have to have a government issued ID, and some of our folks may no longer have a driver's license and may not have received a state issued ID card, so they may also have more difficulty proving identity for the purpose of a notarized signature.
So in this case, because Mendocino County employees are dual enrolled in Social Security, presumably this person was also receiving Social Security.
Yeah, the death went unreported. Social Security benefits were also paid.
It's my understanding, based on your memorandum, that there's going to be a policy or procedure that will be presented at a future date. So we could potentially reserve further conversation regarding that policy at a later time.
And that will provide a better explanation of what alternatives we may offer for the member to verify that they are still alive, and a sample of the form or letter that would go out. So all of that will be brought back within a few months.
Well, the only other thing I might like to suggest before you adopt or present, policy would be if we have any notaries in our office that could assist people that are used to coming to our office to get services, to assist people in that position.
One thought was if they come to our office and provide a copy of their ID, we wouldn't require a notary because they could sign it in front of staff. We do not have a notary on MCERA staff currently. But of course, it only works for the limited number of folks, which are the majority, roughly the 70% who are in this area, and it doesn't help those members who live further away from our office and would need to take care of it. We will do kind of a heads up with announcements that we're going to start this process through our newsletter and other ways, so membership becomes aware of it before they get that first letter from us, and they'll know hopefully that it is truly a valid request and not a scam.
Yeah, and I understand we still have quite a few members living throughout the entire United States and beyond, so, yes, Vice Chair.
Worst case scenario, Jeff, somebody refuses to sign this. I have a pension, I earned it, you pay it or else. Can you give us a little rundown there?
So you're right. I mean, there's going to be practical issues, and we're trying to balance. You can see the difficulty from the questions the trustees are raising. Trying to do the right thing, and there's going to be some issues like that, and we'll have to address them.
My only additional comment, and I get that there could be anything else we're not aware of, but this was one case or one instance that took 10 years to discover. I would highly suspect it's not the norm for our members, but I don't want to overreact to a scenario that is an abnormal situation. So, any further comment or direction?
Historically, staff did do this type of letter or affidavit, but it was stopped many years ago, is my understanding. But we have been discussing for a while reinstituting that process, and we're trying to work out the details to make it beneficial for MCERA, but not too inconvenient for our membership.
Just to add, that letter was sent to all members annually and did not require a signature of a notary.
Understood. All right. I think we can now consider item number 8, received and filed. Brings us to item 10, discussion regarding the administrative report. Executive Director Rentschler.
Thank you, Chair Cromer. I've provided an update on 2 pension gold releases that are expected to be in production this month. One of those is the actuarial extracts that we're updating to provide better information to our actuary. The other is a correction to some general ledger exports that was occurring. We have a new member handbook that is now available. It is on our website. We did also include a link to that in the last newsletter, and I did receive a couple of nice comments saying they thought the information was helpful. As you know, we started a new staff member, and so we are fully staffed right now. And the update on the VCP project is we still have not been assigned to an IRS agent. A legislative report from Sackers is attached. If you have any questions, I'm happy to address any questions you may have on anything on this report.
Any trustee questions, comments? Any public comment?
There is no public comment.
Thank you for your report. Brings us to item number 11, general board member discussion. Is there any board members that would like to discuss anything?
So I have something I would like to see maybe on a future agenda. As I was mentioning, we're not alone in looking at adding, which we have, added infrastructure as well as real estate over time to our, more or less as a middle place between fixed income and equities. Less volatility is the target, although slightly lower returns than equities, but substantially better returns than fixed income bonds. And in conversation with Sonoma County, again, and they're not declaring themselves to be on the leading edge on this, but they've now added 3 different types of real assets. Ag land is the most recent, and so they're going to 26% allocation to real assets, and we have right around, I think it's around 20 or 19% between property and infrastructure. So I think it's something we should be looking at, and specifically, I had a conversation at Sonoma Clean Power where, Sonoma Clean Power is a government agency, County of Sonoma, County of Mendocino, the cities in the two counties absent Healdsburg and Ukiah, and it's like all utilities in that it's buying more and more electricity because we're electrifying the grid, or we're electrifying homes, we're electrifying our fleet of vehicles. It's a growing field. These are, so Sonoma Clean Power purchases contract. It doesn't currently finance the construction of facilities, but purchases long-term contracts. And usually a private company is investing to build the facility, whether it's an array of solar panels or it's hydro or whatever it happens to be, geothermal. And, but there are clearly opportunities in this field of which I would put within the utilities, within infrastructure and real assets. And I would actually say that we have insider information. I mean, it's a government agency, it's a sister agency. We know that they're looking to buy more power. We know where they would prefer it to be in the two counties that they operate, Mendocino and Sonoma, but most of their power is purchased from outside the area. And from time to time that they see proposals to themselves, to other agencies. And I'm just trying to see, is there some way we can look more closely at this investment opportunity? There, right at the moment, might not be a good opportunity, but PG&E is selling off an interest in some of its older facilities that are non-nuclear, and that may or may not be a good investment. But CalPERS, for example, has a real assets management team of employees of Caltrans that specifically look at investing in this space. One of our two funds that we invest with infrastructure, I believe, is a consortium of other pension funds. So I'm hoping that means we're paying less in administrative overhead than if we were paying a private company. Venture capital type folks are looking for very large profit margins for themselves. So whether it's partnering with, I think there would be value in our in a future agenda item that asks staff to look at this, and I would actually say a inquiry from our board to CalPERS and CalSTRS to say, you're the big entities in the state. You've got a staff specifically in this area. Are you looking at investments? Are you looking at real asset investments that you might be willing and want to share a stake for these smaller funds like us? The concept would be that we're paying a lower administrative overhead, we're paying CalPERS, but we're not paying a very high rate to an investment company. And they may say no. If we're going to make an investment, it's just for us. They may say we would consider letting the smaller serials participate in some of our investments, and there's going to be, and we could create a process for you to look at that as an investment opportunity. Again, the PG&E option may not be a good option for us. It may come and go before we could even get something like this underway. But I think that this space of infrastructure and real assets is probably going to be a growing share of our portfolio. Probably needs to be a growing share of our portfolio. I think bonds, we're sucking wind at 2.5% returns, and it's hurting our fund. And I don't trust it's going to go to 4% long term. I think it might be there right now. I think it's going to bounce back down to something closer to 2.5. And so I think we need to keep looking at things like real assets, and I think it would be worthwhile to have a conversation with the little serials and the big guys in the room, which is CalPERS and CalSTRS, to say, are there opportunities that they're looking at that they'd be willing to let the little serials get in on the deal?
Thank you, Trustee Jurdy. Any additional general board member discussion for item 11?
Are you nodding to Dan's thing? Yeah. Yes.
That takes us to item 12, which would be closed session. We have two items in closed session: public employee performance evaluation for our executive director pursuant to Government Code Section 54957, and conference with labor negotiators regarding negotiations with our executive director pursuant to Government Code 54957.6. So we will be in closed session. And we're live. Go ahead, Jeff.
Thank you. So the board met in closed session, and on item 12A, the board gave the executive director her performance evaluation. And under item 12B, the board gave direction to its labor negotiators.
Thank you. That takes us to item 13. The next scheduled Board of Retirement meeting will be held Wednesday, August 16, 2023 at 8:30 a.m. here at the Board of Supervisors chambers, and we are adjourned. Thank you. Thank you all.
Thanks.